Before your paycheck ever hits your bank account, a silent machine slices it into pieces. One slice goes to you, another slice goes somewhere you never see, and the more you earn, the bigger that invisible slice becomes. Most people think they know how federal income tax works. Almost nobody actually does. The system feels simple from the outside, but inside it is layered, technical, and full of rules that quietly shape your financial life. If you want to understand those rules instead of being controlled by them, make sure you subscribe to Tax Hack Pro so you never miss what really matters. Federal income tax in the United States is not one flat rate. It is a progressive system, which means your money is taxed in layers, not all at once, not all at the same rate. Each portion of your income is taxed at a different level, and those levels are called tax brackets. The idea behind this system is that people who earn more can afford to pay a higher percentage on the top part of their income, while lower earners are protected by lower rates on their first dollars. Here is the part that confuses almost everyone. If you move into a higher tax bracket, it does not mean all your income is suddenly taxed at that higher rate. Only the part that falls into that new bracket is taxed higher. The rest stays taxed at the lower rates, but many people believe that crossing into a new bracket will somehow make them poorer, which is not true. For 2025, federal tax brackets range from 10% at the bottom to 37% at the top. These rates apply differently depending on how you file, whether you are single, married filing jointly, married filing separately, or head of household. Each filing status has its own income ranges for each bracket. Imagine you are single and you earn $50,000 a year. The first part of your income is taxed at 10%. The next portion is taxed at 12%. The next portion at 22%. You do not suddenly pay 22% on all $50,000. You only pay that higher rate on the portion that crosses into that bracket. That means even if you move into a higher bracket, most of your money is still taxed at lower rates. This layered system is why two people with very different incomes can both say they are in the same tax bracket, but still pay very different total taxes. One might barely touch the higher bracket, while the other might have a large portion of income taxed at that higher rate. Before the government even looks at those brackets, something important happens. Your income is reduced by deductions. Deductions are amounts the government allows you to subtract from your income before taxes are calculated. This is one of the most powerful tools for lowering your tax bill. There is a standard deduction that most people use. It automatically lowers your taxable income. The amount of the standard deduction depends on your filing status and changes over time. There are also itemized deductions for things like mortgage interest, charitable donations, state and local taxes, and certain medical expenses. Whichever option lowers your taxable income more is the one you usually choose. After deductions, what remains is called taxable income. This is the number that actually gets sent through the tax brackets. This means the number you earn at work is not the number that gets taxed. The tax system always looks at your income after deductions. So when someone says they make $60,000, that does not mean all $60,000 is taxed. After deductions, maybe only $45,000 is taxable. That difference can save thousands of dollars without you doing anything special. Once the tax is calculated using the brackets, the government compares it to how much you already paid during the year. Most people pay taxes through withholding. That is the money taken out of each paycheck automatically by your employer and sent to the IRS on your behalf. If too much was taken out, you get a refund. If too little was taken out, you owe money. A tax refund is not free money. It is your own money coming back to you because you overpaid during the year. Owing money means you did not pay enough during the year and now have to catch up. Some people love big refunds. They see them as a bonus. But in reality, a big refund often means you gave the government an interest-free loan for a whole year. That money could have been in your bank account earning interest, paying bills, or reducing debt. The purpose of federal income tax is to fund the government. That includes the military, education programs, infrastructure, healthcare programs, social security, disaster relief, and interest on the national debt. Every road you drive on, every government building, every federal program is funded partly by this tax. Who has to file a federal tax return depends on how much you make and your filing status. If your income is above certain thresholds, you are required to file with the IRS. Those thresholds change over time, but they exist to prevent very low earners from being forced into the system. Most people file online now. The IRS provides online tools and approved software to submit tax returns electronically. Filing on paper still exists, but it is slower and more likely to create mistakes. For Americans living abroad or people dealing with international systems, the process can feel confusing, especially when compared to systems like Pakistan's FBR Iris portal. But for U.S. citizens, the official authority is always the IRS. The filing deadline is usually in April. If you miss it, penalties and interest can start adding up fast. The IRS does not forget. It does not lose records. And it rarely forgives without a reason. Even if you cannot pay, you are still expected to file. The progressive tax system is designed so that people who earn more pay a higher percentage on the top parts of their income. This is meant to balance the tax burden across society. Whether that system is fair or not is debated constantly, but that is how it works. One of the biggest mistakes people make is misunderstanding their tax bracket. They think moving into a higher bracket will make them poorer. In reality, earning more money always leaves you with more after-tax income, even if part of it is taxed at a higher rate. Another mistake is ignoring deductions and credits. Deductions reduce your taxable income. Credits reduce your tax bill directly. A $1,000 credit reduces your taxes by $1,000. That is more powerful than a deduction that only reduces the amount of income being taxed. Credits exist for things like children, education, energy efficiency, health insurance, retirement savings, and low income. Some credits are refundable, meaning you can get money back even if you owe no tax. Others only reduce your bill to zero. There are also special rules for self-employed people, freelancers, and business owners. They often have to pay estimated taxes during the year instead of waiting until April. They can also deduct business expenses, which lowers their taxable income. Bonuses, overtime, and side jobs are often taxed differently at first because of how employers calculate withholding. That can make people think they are being taxed more, even though it usually balances out when they file their return. Understanding this system changes how you see your paycheck. It changes how you plan your income. It changes how you think about raises, bonuses, side jobs, and extra work. When you earn extra money, that extra portion might be taxed at a higher rate, but you still keep most of it. Fear of tax brackets should never stop you from earning more. Federal income tax is not just a number on a form. It is a system that quietly shapes your life, your career, your spending, and your future. The more you understand it, the less it controls you. Every dollar you earn travels through this system. Some of it stays with you, some of it leaves. The real power is knowing why, how much, and how to legally keep as much of your own money as possible. And if you want more simple breakdowns like this that actually help you keep more of what you earn, make sure you subscribe to Tax Hack Pro, because the tax you do not understand is the tax that costs you the most.